Good day once again. Back to our classroom, back to our studies, and back to technical analysis once again. 3 times in a row. But I'm sure it's not going to be boring, it's going to be very interesting once again. We've already done 2 sessions of technical analysis. This is the 3rd session, and I think by the time we end up this session, we should have a good insight about technical analysis. Now, very briefly, from where we left off last time, a little bit prior to that, what things there were in technical analysis. And remember, we had price patterns, trends, moving averages, charts, and indicators revolving around the technical analysis. We had talked about trend lines, we had talked about upward trend lines, we had talked about downward trend lines, and we had talked about ranging trend lines. Like we said, upward trend lines would help you get into the market to buy shares. A downward trend line would get you to get out of the market from any position that you're holding, and a trading range would maybe tell you to keep away from the market or keep on the sidelines or be careful in what you're trying to do in the stock market. But generally, money can be made on all 3 trends, whether it's upwards, downwards, or is a trading range. The only thing important is for you to enter at the right time and get out at the right time. We had also talked about supports and resistances, in which we talked about previous highs becoming a benchmark for resistances and previous lows being a benchmark for supports, and then a breach of these previous resistances and previous supports being a direction towards a new trend in the market or a new trend in the price movement. Now, supports result from inability to break the price support, and resistance size as well is the same. All supports change into resistance once breached, and all resistances change into support once breached. This was what we talked about last time about trend lines and supports and resistances. We had also talked about moving averages, and we had specifically talked only about simple moving averages. We talked that the moving averages are smoothing of the price movements over an n period of time, and we had decided that a good time to be in the market would be when the prices are playing upwards of the moving average, and a bad time if the market prices are moving below the moving averages. The direction tells you where the market is going and where you should be getting into and getting out. This was the simplest part of the moving average, which I told you was trading when up on the moving average and getting out when prices were down below the moving average. Remember, you can make variations in the moving averages because it is up to you what level playing field you're going to be playing in. Whether it's going to be short term, the mid term, or the long term, and then the end periods could range from 5 to maybe 200 periods for the smoothing of a simple moving average. I'd also talked about price patterns, but price patterns are what we're going to talk about in detail today. We had talked that technicians look for patterns from historical data. These patterns tend to continue, and these technical analysis in the efficient market hypothesis may not be perfect and may be just illusions. They may not be real. In fact, there can be seen in general that these are all random price pattern movements. But there are formations in price patterns. Remember, in one of the previous lectures, I talked about the head and two shoulders. We all have a head and two shoulders. But this head and two shoulders we're talking about is in the technical analysis of stocks. So you'll find price patterns in which a certain price pattern will make one shoulder, maybe the left shoulder, and then peak towards a higher pedestal, turning it into a head, and then a right shoulder. Obviously, since you have a head and two shoulders, there will also be a neckline, and a breach would determine a reversal in trend. So we would have a proper head and shoulder, and we would have a reverse head and shoulder as well. A general head and shoulder would show maybe this is going to be a reversal on the downside. An inverse head and shoulder would maybe tell you that we're going to have a change in trends on the upside. Now, these breaches in necklines determine what sort of a direction you're going to get, or maybe if there is going to be a failure. But generally, when and if the necklines are breached in the head and shoulder formation, the trend then continues in the direction where the head and shoulder formation has been made, a straight one or an inverse one. So these reversals can make you decide what sort of a market you're going to enter into and which direction you're going to enter into. An inverse head and shoulder, once again, will tell you the market is bottoming out and going upwards. And a straight head and shoulder, on the other hand, will tell you it's time to get out of the market. There may be a variation in head and shoulders, and you might find a tilted head and shoulder, so one shoulder might be lower than the other shoulder, but that's not important. You may have a symmetrical shoulders towards the head, or may have one drooping or one inclining shoulder. But the head should be clearly visible between the two shoulders. You may also have two shoulders on one side. Of course, I do know we only have one, but in the technical analysis, you might just have two shoulders. But these are all variations that you will try to understand once you know the inside of capital market technical analysis. But back to just the basics, two shoulders and one head is good enough to you to find out what the direction of the market is. Now, this is one of the very exciting formations that people try to find out, and there are sometimes breaches, and then there are also times where you'll find out failures to breach the neckline. Because unless necklines are breached, there is a failure in the pattern. And remember, it is not necessary that whenever the head and shoulder has been formed, there is definitely going to be a breach of the neckline. No, it may not. It may be a failure, and the market might not take the direction of the head and shoulder. But this is all visible in the formation and the price patterns. It's not something that's elusive of human eyes for you not to be able to see them. You can look at them once you have got a feel of what the head and shoulder looks like. These head and shoulder formations can be applied on the entire market or one specific individual stock. It all depends how you're looking at the market. Now also, we must understand that prior to getting into the price pattern formations, we need to understand that these head and shoulder formations may or may not help you determining the direction of the market. But generally, these are guidelines. If you're able to understand these formations and price patterns, you'll be able to make good money in the capital markets. Another pattern that can be looked at other than the head and shoulder formation is the bottom formations. The bottom formations are probably more inclined to be a rounded bottom, which I had mentioned in the earlier lecture. Rounded bottoms and rounded tops, or cups or saucers, are indicating towards a slow reversal in the trend. These are different from head and shoulders, and these are slow in forming your opinion and slow in showing you the direction of the market. Rounded tops and rounded bottoms are to be seen as slow reversals in a market's continuing trend. Now, you can't have exact picture perfect bottoms and tops. You have to assume that these are going to be taking shapes of bottoms and tops to understand that there is going to be a reversal and there is a weakness in the strength of the trend. Generally speaking, when you have weaknesses in trends, you'll have slow reversals based on volume studies as well, and we'll study them as well. Just a quick glance at a formation for the head and shoulders that you are able to see on the screen, and we have shown through the tops, we have put on indicators on the shoulders and on the head, and of course we've drawn lines to show you the neckline and where the breech is going to be. One thing that I must add here is we're also able to measure the distance of the change in trend based on the neckline and head distance. So that is sometimes taken as an indicator. This is the minimum reversals that will be seen in the price movements on the upside or the downside. So neckline breaches can also be measured, that stocks will definitely or certainly go towards a certain price movement when changing takes place in reversals. Now, I had just mentioned bottoms and tops. And in mentioning bottoms and tops, I had mentioned that this is an indicator of a slow reversal. Now here I'd also like to mention you double tops and double bottoms. Now a double top and a double bottom would be a formation which is a little different than the head and shoulder, because I mentioned in the head and shoulder that you'd have a head higher than the shoulders, but in a double top you'll have almost identical tops. And on the lower side, bottoms would be identical too. Now, these also indicate failure in the continuation of a trend. These also indicate that maybe you might find a reversal in the trend now. One top would indicate a previous high reached, one bottom would tell you a previous low level being reached, and another one touching the same level would be understandable. This probably could be the place where the market is going to take a reprieve or will not be able to breach the previous high. This is actually what the implication of a double bottom or a double top is. If it's a breach, obviously we won't have double bottom and double top, but generally speaking, this is indicative of again a change in trend reversals. So two tops or two peaks. Sometimes you have peaks, sometimes you have bottoms, which looks like a W. The top would look like an M. The bottom would look like a W with two bottoms or two tops. Would be a reversal in the trend of the stock or the market. These are also good indicators for you to be able to understand when to buy and when to sell. These don't happen frequently, but in good studies, we can look at these price patterns. For your convenience and to tell you what actually is happening, I have taken the opportunity to show you on the screen what a double bottom actually looks like in real time, real life. This on your screen is a classic W or a double bottom formation in our local markets. And a breach of the neckline, in this case, shows you the direction is going to be upward. Now look at how wonderfully the double bottom has worked and how wonderfully well the market has increased in the direction going upward. This is what a double bottom looks like, and this is how the market reacts when the market is going to breach and go upwards. Now, like double tops and double bottoms, we have another formation in price patterns which is called triangles. Now, triangles can be of different types. Triangles can be ascending, triangles can be descending, or triangles can be asymmetrical. Generally speaking, if we have an ascending triangle, we shall assume that the market is going to go upwards. If we have a descending triangle, it shall be assumed that there is a weakening in the market and the market is going to go down. But then we can have symmetrical triangles as well. Now, a good price action and a price pattern in a triangle will normally make a breakout on either side at 2/3 of the triangle. बिल्कुल ट्राइंगल के एंड या एपिक्स या टिप पे जाके मूवमेंट नहीं होगी प्राइस की. ये 2/3 ट्राइंगल जहां पे होगा वहां से ही डायरेक्शन ले लेंगी अपवर्ड्स और डाउनवर्ड्स. दैट इज गुड ट्राइंगल जहां पे प्राइस. सो इट्स एक्चुअली लाइक अ स्प्रिंग जिसमें share prices are going to narrow down like a spring and then jump back when they break out of the triangle. So your spring coil effect is seen when a breakout is seen out of the 2/3 portion of triangle. Triangles always tell you the direction. Triangles also tell you how swift the direction is going to be depending on how big or how small the triangle is. But these triangles are drawn with the help of trend lines. You have to find the price patterns inside the movement of the shares. These price patterns have to be identified. These price patterns are there for you to notice. And it doesn't matter if the symmetry is the same, the asymmetrical or ascending upwards or downward, but you are able to find out triangles and you are able to make a decision whether to get out of the stock or the share or the market, or you're able to make amendments to whatever decisions you made in your trading activity. Now, with head and shoulders, with tops and bottoms, with double tops and double bottoms, and with triangles, we have other formations as well. Here I'll just wait for a while to show you what a bottom looks like. So look at your screens and you'll find a bottomed out script at the lower side with a reversal going on top. These indications are good for technical followers and are able to make good money into the investments by finding out price patterns. Identifying price patterns is the art that I'm trying to tell you in this lecture, and the way you can use these to aid your investment analysis and investment management decisions. These rounded bottoms, these cup and saucer formations are going to tell you that this is time to enter into the market, for you to find out that the market will definitely then go up. Now, with the triangle I just mentioned, with the peak of the triangle or the apex of the triangle towards the right, we also have broadening formations. This would again be a triangle, but this would be an expanding triangle, with the triangle starting from the left instead of ending on the right. So these are broadening, expanding triangles where you'd have broadening tops and broadening bottoms, where share prices tend to expand in their prices. These are also reversal patterns. These usually signal a reversal of the trend. They have the same impact that we've seen in triangles. Maybe the triangles were being formed with the apex here, but these are broadening triangles with share prices moving in an expansive way. So we can have broadening bottoms or broadening tops in these kind of formations, but they still remain triangles in a sense. But these are all also indicative of reversals or continuation of reversal or change in reversals. These can also be termed as pennants if they're short in body, or they can call them large triangles, small triangles, or intermediate triangles, all depending on the size of the price movement. There is no such thing as a picture-perfect price pattern. There will be little bits of whipsaws in price patterns, but generally speaking, we need to be able to have the ability to identify them. Remember, no such thing as a picture-perfect price pattern. We have to find out the patterns. And in every graph, there shall be patterns. Obviously, since there is volatility in the markets, there is volatility in price movements, we cannot have a chart formation without price patterns. The only time we'll have no price pattern is when there will be static line and there is no movement in prices of the shares. As long as there are movements in share prices, there shall be price patterns. Whether there's bands, whether they are going to be triangles, whether they're going to be expanding formations, whether they're going to be double tops and double bottoms, whether they're going to be single tops and bottoms, or they're going to be head and shoulder formations. So you to be able to find out all these patterns while looking at the stock market activity. Once again, it is the ability to understand the basics of technical analysis for you to be given the ability to find out price patterns and use them to your advantage. If you interpret wrong price patterns, the patterns will definitely work against you and your investment decisions. These price patterns need to be followed when they give you an indication to buy, and then follow when they give you an indication to sell. These price patterns that we seek in the formations are essential for any successful investment profitable decision, and obviously these are things that will keep coming up in all these formations. Now, in the different charts that you keep looking at, and these keep appearing on the screens because there are a number of them coming up, you'll be able to find out gaps, you'll be able to find out double bottoms, you'll be able to find out trading ranges and bands. Gaps is another formation that we look at, and these are windows or gaps in the when we have very strong trends on the downside and upside. You'll find gaps from one day's close to another day's close. And then we also see these price movements coming back to fill in the gaps. Until then these remain as supports or resistances depending on where the market is going. You'll find triangles help you out, you'll find descending triangles, you'll find all sorts of images in the price patterns. Now, this was all about price patterns. I had already told you about the different types of charts. Now we need to understand into another thing called indicators. As the name implies, indicators indicate trends. There are literally hundreds of technical indicators used to generate buy and sell signals. But we can't look at all of them, we'll just look at a few of them. And the few of them which are very popular, which would mean we would be looking at the moving average convergence divergence indicator, more commonly known as the MACD indicator. We would also look at the relative strength index indicator, commonly known as the RSI RSI indicator. Then we would also look at the on-balance volume indicator, or the OBV normally called. These are the indicators that we shall be looking at. And one more indicator that I'll let you know about is the Bollinger Band indicator. So these are the indicators that need to be studied in detail. 1, the MACD, 2, the RSI, 3, the OBV, and 4, the Bollinger Band. Now these are common indicators mostly used, MACD and the RSI indicator. Of course, we have one volume indicator, the OBV, or the on-balance volume, and the Bollinger Band indicator as well. Now these have been created by students and teachers of technical indicators, and they are referred to sometimes to their own names, or they are more popularly known by the study that the researcher has been going into. What is the moving average convergence divergence indicator, the MACD? This actually is an oscillator, and it is a good indicator for you to be able to study, which is used along with the shares pattern. This is not a chart pattern. This is a separate study that is used with the chart pattern. Now, I would like to mention that this was created by a gentleman called Gerald Appel, and he found it as a way to keep track of the moving average convergence and divergence, or moving average crossovers. So we had different n-period moving averages, like the 12-day moving average and the 26-day moving average, and a 9-day moving average of this difference was used as a crossover to generate signals. So when the signal line goes from negative to positive, that is an indication for us to buy the share. When the signal line goes from positive to negative, it simply tells us that a sell signal has been generated. We also use this very wonderfully in choppy, trendy market. We're able to use this, look at the whipsaws, and get in and out rapidly with little or no profit. So in trendy or choppy markets with whipsaws, we may or may not be getting a lot of profit, but we are able to move quickly with the trend. So an MACD is a good indicator of buying or selling based on a 12-day and a 26-day moving average with a 9-day moving average signal generating indicator. So we use this in conjunction with the share prices, and this is worked on as a successful model of moving averages. Remember, the bottom line is that it is an expanded variation of a moving average. In fact, is a collection of few moving averages, more than one. I had told you about one simple moving average, but this is more like using two moving averages and then having a crossover of moving averages and generating signals. You can change the end periods to your convenience depending on how good it is being utilized in the particular share. It may just not be appropriate that one share's indicator of the moving average convergence divergence may be applicable to another share as well. So you sometimes have to tinker with it and make an improvement on the workability of the MACD indicator. You might just be able to look at the screen and have a look at how an MACD indicator moves along with the share prices. MACD crossover will tell you where to buy, and then on the screen you will notice that wherever there has been an indication, and in case there has been an indication for you to get into the market and buy shares at exactly the place where there was a crossover of the moving averages convergence and divergence indicator. MACD crossover tells you, yes, this is time for you to buy and get into the market and get some profit into your investments. So these are the indicators. The first indicator I've just mentioned you is the moving average, convergence, divergence, more commonly known as the MACD indicator. Now another indicator, more popular, I believe, more popular than the MACD. As far as I am concerned, I feel much more happier with the relative strength indicator. Now in this indicator, the relative strength is seen as a measure of how the share is behaving. Now coincidentally, Mr. Apple had created the previous indicator, the MACD. This was created by a gentleman called Mr. Wilder. Mr. Wilder saw it as an oscillator telling you where to get in and where to get out of the market. This was generally scaled and measured on the average of price changes on up days and down days. This had a scale of 100 with levels of 70 and above, indicating that a stock is overbought. An indicator below 30 telling you that the stock is oversold, but it can range from 0 to 100. The RSI realizes that stocks can remain overbought and oversold for a long period of time. It's not always convenient to use one indicator to determine your decision-making philosophies. You may combine two indicators to confirm your investment-making decisions. And it's always a good idea to have a supportive indicator to confirm the original buy or sell signal. Now यहाँ पे आपने पहली दफ़ा दो टर्म्स सुनी हैं, ओवरबॉट और ओवरसोल्ड की. अब ये क्या है? ओवरबॉट वो कंडीशन होती है जिस पर मार्केट को इंडिकेटर बता रहा होता है कि शायद ये ज़्यादा लोग इसमें बुलिश हुए हैं और more people are keen to buy the share. Now remember, we had also talked about volumes as well and averages as well. So the relative strength index tells you whether there actually is strength in the share or not. So RSI's overbought condition above 70 tells you that it's not a good idea to be buying here. It's actually a good idea to get rid of the shares. Now just look at the graph, and you look at the graph and see how the indicator has been telling you, and it shows you both overbought conditions and oversold conditions as well. And they match perfectly with the price indicators as well. So once again, an RSI indicator tells you above 70 that the market is overbought, and if it is below 30, it indicates that the market is oversold. You buy in an oversold market below 30, you sell in an overbought market when it's above 70. So RSI is a good indicator to tell you when the market is overbought and oversold. The figures that have to be noticed are the 70 for an overbought condition and a 30 for an oversold condition. Now we have another indicator I had mentioned was the OBV. This is an interesting indicator because it's based on volumes. It's not based on price movement. So this is a very exciting indicator. OBV, or on balance volume, was created or developed by a technical analyst called Joseph Granville. And he did it in 1970s, and he was one of the most famous technical analysts I've known. Joseph Granville, creator of on balance volume indicator. Now what does the on balance volume do? I told you it's about volume studies. Now, OBV is calculated by adding volumes on up days. and subtracting volumes on down days, and a running total is kept. Once again, volumes on up day, and you subtract volumes on down days, and you get a result, and the running total is then kept, indicating the trend of the share. Granville believed that volumes lead prices. Volumes indicate where the trend is going to change. And volume studies based on this are quite interesting. We have had a number of oscillators in our portfolio. Volume studies are something that must be added with indicators. To use the OBV, or the on-balance volume indicator, we generally look for OBV to show a change in trend, in divergence, or maybe some sort of indication that a trend is going to change based on OBV studies. So if the stock is in an upward trend, but OBV turns down, that is an indicator that maybe the stock hasn't got enough fuel in it to take the share further higher. So that could be an indicator that the share is going to see a reversal soon. Once again, if the share price is going up, but you see that the on-balance volume indicator is not going up again with the graph, and probably showing a divergence downward, would just show that there is lesser gap between up days and down days, and the total that has been kept running, you will notice, will show you that there's going to be a weakness in the trend, and maybe a reversal could be nearby. So on-balance volume indicator, or a volume-based indicator, helps determine reversals as well, because as per the study by Mr. Granville, volumes lead price changes. मैं समझता हूँ कि वॉल्यूम्स वाकई ही आपको बता सकते हैं, क्योंकि मैं भी जब स्टडीज़ करता हूँ तो देखता हूँ कि वॉल्यूम्स अगर तो ज़्यादा हैं एक डायरेक्शन में, तो उसमें मार्केट की स्ट्रेंथ का पता चलता है. मार्केट अगर बढ़ रही है लेकिन वॉल्यूम्स बढ़ नहीं रहे, तो ये अंडरस्टैंडेबल है कि इतने ज़्यादा आपके पास बुलिश बायर्स अवेलेबल नहीं हैं जो मार्केट को सपोर्ट करें अपवर्ड्स. तो ये वॉल्यूम्स आपको हेल्प करते हैं डिटरमिन करने में कि भाई वाकई शायद रिवर्सल आने वाला है, क्योंकि अब ज़्यादा फ्यूल, ज़्यादा स्ट्रेंथ नहीं लग रही मार्केट की राइज में या फॉल में. एक और इंडिकेटर, और ये उन साहब के नाम पे ही है जिन्होंने ये क्रिएट किया है. इट्स कॉल्ड द बुलिंगर बैंड्स इंडिकेटर. This was created by Mr. John Bollinger. Now, these again are moving averages, except they're not one but three moving averages, or maybe one moving average with two standard deviations up and below the moving average. You will see a band of three lines with one moving average in the center, with two standard deviations with n periods on both sides of the moving average. Now, these two standard deviations make a band for the share price to move within. अब इसमें क्या है? इसमें buy signals generate कैसे होते हैं? Buy signals are generated when the stock price closes below the band, when stock prices close below the lower band of the Bollinger indicator. And that is an indicator where you can then buy the share. On the other hand, a sell signal is indicated when stock prices move up and close over the upper band. That is an indicator where you can sell your share. So you have an indicator to buy when share price is below the lower band, and a sell indication when it's moving above the upper band. There are two standard deviations I mentioned before. Now there are a lot of variations in the Bollinger band. Bands may expand, meaning standard deviations may go further from the medial moving average line, or bands may contract. Now this again, contraction is an indication that a new direction is going to take place in the movement of the prices. Sometimes you're unable to find out the directions, but generally speaking, contractions definitely tell you there's going to be a big price movement in the prices of the stocks. So as long as the prices are moving within the Bollinger Band, you may find it all right for you to get inside the act and understand where the direction is going, but buy and sell signals always outside the bands. Through experience, I've generally found that buy signals are much more clearer in this study. Now, by looking at the graph, by looking at the chart on your screens, we've seen a lot of screen charts here because it's important for you to look at the actual charts to be able to understand them. So once again, this chart in front of you, the Bollinger Band chart example, shows you how prices will be given a buy signal or a sell signal, and sometimes buy signals tend to be generated at bottoms or inside. But remember, there's no such thing as perfection. There can be failures, and there can be good results from going with these indicators. Now, very important to mention a gentleman called Charles Dow. And we would be looking at the theory that he created. The theory was called the Dow Jones theory. This was in America way back in 1902 that Mr. Dow found a series of patterns that he wrote about, he talked about, and then worked on them. Dow, and later a few others as well, believed that market trends forecast trends in the economy. Now this is very interesting. We always thought that economic indicators also affected the capital markets, but here is a study which forecasts that capital market trends indicate or forecast economic trends in the economy. So the indicator or the index that was named after Mr. Dow was called the DJIA, or the Dow Jones Industrial Averages Indicator, a very popular universal indicator which the entire world follows. A change in the trend of DJIA, or the Dow Jones Industrial Averages, must be confirmed by a trend change in the technical analysis. And then only a valid signal is generated to find out about the trend. Now, this was a very expansive, extensive, thorough study theory, the Dow theory. And this normally talked about big patterns or big events or big changes in your price patterns. It really didn't worry about the smaller movements on a day-to-day basis. In fact, the Dow theory ignores the day-to-day fluctuations. It's more focused on primary trends, or like Mr. Dow used to call them, waves or the tides. The primary trends were tides, big. And these tides showed that this is the trend that defines the long-term direction. So tides were used as terms for long-term directions of a market. And others have called this a secular bull or bear market. Now we also had secondary market trends called waves. And these were of shorter time spans or time durations or term. These were for smaller terms than the primary trend. if I were to say that tides were for years long trend, a year or more, these wave trends or secondary trends would be termed as trends for months or maybe weeks as well. And I have already told you, Dow ignored day-to-day fluctuations. The intraday fluctuations, not very exciting. That may be exciting for jobbers or day traders who dwell on day-to-day trading. They buy in the morning, get out in the evening, go home clean, no positions to be carried over on for your luggage to carry to take back home. These were indications that Dow ignored and focused just on the primary trend or the long-term trend or secondary trend or the wave trend, which was for a shorter duration of time. But very interesting, short-term trends are trends that we here follow and ignore the primary trends or the long-term trends because we are really impatient to get rich quick and can probably not wait for the long term. So we generally get ourselves stuck in day-to-day trading or maybe term trading like in weeks or months, but really do not try to get out of this into the long term where the big money is. But like I said, patience is required for long-term investments. And patience is something that we lack, and that's why we don't make enough money. So within a bigger trend, within a primary trend, we can have smaller trends as well. If we have a long-term trend, let's say on a 5-year horizon, we might be looking at smaller secondary wave trends which might last for 1 year or less, but the bigger trend would be intact. So it's not surprising to find smaller trends making different directions in a bigger long-term trend. So there is the term that we come up with then, trends within a trend. So you have smaller trends and bigger trends, grander trends, huge trends that span for years, but since we do not have the expertise to look at our studies because we don't have a very long history of our stock markets, we just began when we became independent, so we might not be able to look at the really big cycles that Mr. Dow talked about. Now, the beauty about going with the Dow trends was that if you got into by buying and selling every time a trend was indicated, you tended to get more out of it than just buying it when one day and then holding it for a very long period. So an example that was given, if you put in, like they said, $44 in 1897, that's a long time ago. And if you had it checked in 1981, you would have made around $18,000. That is a lot of money going from $44 to $18,000. But if you just stuck to it in 1897 and sold it by 1981, your $44 would have gone just as high as $960. So taking advantage of the trends within the trends, in buying and selling as the indicators came in with the Dow theory, you were definite to make more money instead of just holding on to the shares that you'd bought earlier. Now, this might sound weird to you that I'm giving you an example that's spanning more than 100 years, but mind you, in Western developed countries, 100 years is not a long term at all. Balki, I was just reading it the other day in the newspapers, उन्होंने एक 300 साल के बाद मैच्योर होने वाला बॉन्ड इशू किया है. Now that really is long term. अगर यहाँ पे इसको ऑफर किया जाए तो मेरे ख्याल है कि हंसते हंसते लोग थक जाएंगे, पर 300 साल के बाद वो मैच्योर होगा. Look at the confidence of the investors. They really think long term and nations who think long term live long term. Now, what was all this about? It was all about patience. It was all about waiting for the right time to sell. Long-term investments is the name of the game. There's no shortcut to successes. There is no meal as a free meal. You have to earn it. You have to earn your lunch. You can do it right by investing with the right indicators, like the Dow Jones indicator, or looking at other indicators like MACD, RSI, looking at chart patterns, looking at tops and bottoms and head and shoulders, looking at all the reversals and the triangles that can be seen in technical analysis. This is something of value for you. I'm sure you've enjoyed it in your spare time because it's going to be fun studying technical analysis. Thank you.